Hey there, I'm Bev from bookkeepingcoach.net. With over 30 years in bookkeeping and finance, I've seen it all and fixed it all. Whether you're a new bookkeeper or a business owner handling your own books, I know how overwhelming it can get when there's no one to turn to with questions. That's exactly why I created this channel. No more messy books, no more sleepless nights. Just clear, practical advice from someone who's been in the trenches. So hit that subscribe button and let's transform those financial headaches into financial clarity, one entry at a time. Bookkeepingcoach.net, your questions answered, your business empowered. Welcome back to our QuickBooks Online tutorial series. Today, we're demystifying journal entries, a tool that maintains accuracy when used properly, but creates unnecessary complexity when overused. I'll give you the professional confidence that comes from mastering this fundamental accounting tool. I'll show you when journal entries are essential and when they create problems. You'll learn a step-by-step approach that ensures every journal entry balances and makes sense. I'll also share documentation secrets that make your journal entries audit-ready. Understanding when to use journal entries versus regular transactions is crucial for maintaining clean books. Journal entries are appropriate for period-end adjustments, including accrual and prepaid adjustments, depreciation recording, bad debt provisions, inventory adjustments, and reclassification entries. Use journal entries for error correction scenarios like account reclassification, amount correction entries, period correction entries, consolidation eliminations, and opening balance adjustments. Complex transaction recording sometimes requires journal entries for multi-entity transactions, non-cash transactions, allocation entries, reversing entries, and statistical or memo entries. However, avoid using journal entries when regular transaction types would work better. If you can record something as a bill, check, invoice, or sales receipt, use those methods instead. They provide better audit trails and are easier for others to understand. Journal entry structure and design should include essential components like clear descriptive narration that explains the business purpose. Select proper accounts that reflect the actual nature of the transaction. Ensure accurate debit and credit amounts that balance. Make sure you include supporting reference numbers and use appropriate effective dates. Documentation requirements are critical for professional journal entries. Attach calculation worksheets that show how you arrived at the amounts. Reference source documents that support the entry. Include approval documentation as required by your internal controls. Cross-reference related entries and explain the business purpose clearly. Professional formatting standards include using a consistent numbering system, ordering accounts logically, presenting amounts clearly, verifying date accuracy, and ensuring reference completeness. Recurring entry setup and management can save significant time for regular adjustments. Develop templates for standard monthly accruals, quarterly adjustments, annual recurring entries, seasonal adjustments, and allocation formulas. For automation and scheduling, set up recurring transactions with appropriate review and approval workflows. Establish amount adjustment procedures for circumstances when they change. Create exception handling protocols and monitor performance regularly. Common recurring scenarios include rent and utility accruals, payroll, accrual entries, interest expense accruals, prepaid expense amortization, and revenue recognition adjustments. Frequent error patterns include technical accuracy issues like unbalanced entries, incorrect account selection, wrong debit and credit designation, mathematical errors, and date and period mismatches. Documentation deficiencies often involve vague or missing descriptions, lack of supporting calculations, missing approval documentation, inadequate cross-references, and poor filing organization. Conceptual errors include inappropriate use of journal entries, circumventing normal processes, allowing temporary fixes to become permanent, creating complex entries without explanation, and failing to create reversing entries when needed. Documentation standards and organization require specific materials, including calculation worksheets, source documents, management approval, policy reference documentation, and cross-reference schedules. Organization and filing should follow a logical filing system with easy retrieval methods, consistent naming conventions, coordination between digital and physical files, and compliance with retention requirements. The review and approval process should clearly establish review level requirements, verify approval authority, create exception handling procedures, and implement quality control measures. What are your biggest concerns or areas of confusion regarding journal entries? Have you encountered specific situations where you're unsure whether to use a journal entry or another transaction type? Share your questions in the comments below. I'm offering a free 30-minute journal entry consultation. I'll review specific journal entries for accuracy and appropriateness, demonstrate proper documentation techniques, and help you create templates for recurring journal entries. The link to schedule is in the description below. Thanks for watching, and join me next week for our final video on inventory management in QBO.